Good morning and welcome to the weekly commodity market update. We are your hosts. I'm Will Robinson from Brownfield and Ben Brown from the University of Missouri. Good morning, Ben.
Good morning, Will. Hope you're having a good day.
Yeah, trying to. It's been an early start today. Before we really jump into things, can you tell the listeners a little bit about yourself so they know who you are?
Yeah, so my name is Ben Brown. I'm an extension economist here at the University of Missouri and hold an appointment with the Food and Ag Policy Research Institute, or FAPRI, as many people know us by our acronym. I grew up in West Central Missouri on a beef cattle and row crop operation. My family still runs that operation today and look forward to the opportunities when I get to go home and help out.
Well, kicking off today, can you give me a market recap? What have we seen from the past week?
So this week was kind of similar to what we saw last week, up pretty much across the board. And we'll go through some of these different components, but really highlighted by the soybean complex. Old crop soybeans were up to $15.81. That's an increase of 91 cents over the last week and an increase over 3 weeks of $2.30. Now, I haven't done the math, and I don't know how many times we've had weeks that strong, or at least a period of 3 weeks with that large of an increase, but a significant increase over a 3-week period. The new crop soybean contract for November was up 49 cents to $14.16. And the corn complex, the old crop corn for March was up 9 cents. New crop December corn was up 8 cents to $5.81. When we look at the wheat complex, wheat was up 7 cents to $7.68 for that old crop corn contract for March, and then the new crop wheat contract was up 10 cents to $7.70.
So really kicking things off today, I want to talk about soybeans because you mentioned that remarkable kick up over the last several weeks, but especially here recently. Really, that's kind of starting with South America and private estimates driving the market. Can you talk about that?
Yeah, no, you're absolutely right. Last week's rise in the grain markets was especially led by soybeans. It gave some soybeans some fresh fodder to see that upside. We've been trading pretty sideways for a couple of months, and then January just broke out of that channel to the upside. And as I mentioned, we've gained $2+ in the last less than a month. A lot of that was due to private yield estimates giving extra gas to the fire last week. These are estimates that come out the first of the month from people in Brazil and market analyst firms across the country. I always like to remind folks that it's extremely hard to estimate soybean yields, especially prior to when the combines get rolling in the field. Last year, we had a great example here in the U.S. U.S. producers in the upper plains, and along with everybody else, underestimated the yield losses or the yields in the northern plains, Minnesota, North Dakota, South Dakota. So it's really hard to get a good idea of what soybean yields are going to be. Combines are rolling in the northern part of Brazil. They haven't really started yet in southern Brazil. And so in the next couple of weeks, we'll get some more accurate combine data for that particular region. But those private estimates that I was talking about came in about 15 to 20 million metric tons below where those same companies were in December. So just 2 months ago, we've seen a pretty drastic decline in the size of the Brazilian soybean crop. Almost all of that is coming from southern Brazil, which was hit hardest by drought.
So that's propping up the soybean market on that side. What type of corn revisions have we seen in South America, especially in Brazil?
Yeah, so a couple of offsetting factors on the corn side. So again, southern Brazil, the part we've been most concerned about in terms of the drought and the dry weather is where Brazil grows most of their first crop corn, represents about 25% of their total corn production. So I'm going to start with there, and then we're going to switch to their second crop corn. We've seen some revisions, and even though we have seen some deterioration in that crop, it is progressing. The U.S. Embassy in Brazil made a reduction to total corn production down to 113 million metric tons, which USDA is at 115 million metric tons. They'll get a chance to revise that tomorrow in their updated reports. But that was down 3 million metric tons in January. So again, that corn crop continues to decrease. The reason I say that we have some offsetting fundamentals for corn is Brazil then turns around and grows a second crop corn crop that represents about 75% of their total production. The majority of that crop has not been planted yet. And just like here in the United States, when you get price signals and increased prices, it encourages people to plant more corn. And so with the southern crop deteriorating and pushing up corn prices, the northern corn region, where we see a lot of that safrinha or that second crop corn, they're seeing strengthened prices. They've had adequate rain. Their soils are recharged with moisture. And so in total, the expectation is that Brazil will increase corn planted acreage 5.5% year over year. And that's going to help alleviate some of those losses in southern Brazil. So even though yields are really bad in southern Brazil, they still get the opportunity, something that we don't have here in the United States, to go in and actually increase acreage and again in that second crop. So they get a chance to respond even before we do again. So
flipping over to wheat a little bit, talking about some tensions there. We've seen Russia and Ukraine and tensions between the two really drive the market the last several weeks. But what's the main driver now? Is that still it?
Well, some of the other commodities are pulling up wheat, or at least helping to insulate the wheat prices. Soybeans and corn both seeing some increases here the last week or two, and so that's helped prop up some of the wheat. Wheat is this is a very difficult time for wheat fundamentals, just because the wheat here in the winter wheat growing region is dormancy stage. There's a lot of speculation about that. We haven't planted the spring wheat crops yet. And, we look globally, and again, we've talked about this Russia and Ukraine battle, and everybody's talking about it, and it seems to have eased a little bit. But there's just not a lot happening in the wheat complex, and certainly nothing that's going to change the picture in the next couple of weeks. It's just going to kind of hang around with everything else over the next couple of weeks.
What other news do you have on the feed grain side of things?
Yeah, so one of my favorite things on the week, and I'm going to butcher this country. So we do follow grain sorghum. There's not a lot of grain sorghum makers in parts of the country, but it does matter and for feed use and things like that. And certainly in 2020 and 2021, we actually saw grain sorghum have basis bids $1 better than corn. So it does come into play from time to time. So I do follow grain sorghum. This week in the export inspections report, we saw grain sorghum exports of 6.1 million bushels. That's a decent week for grain sorghum. A lot less than any of the other crop or corn, soybeans, and wheat, but a decent week. And then you look at the two largest buyers, and China has largely been driving this market, representing about 98% of total export inspections week in and week out. However, this week we had a surprise addition, and it shows up every so often in Eritrea. I can't say that country right. It's in the eastern part of the African Horn. They largely just export or import grain sorghum for feed use and then some human consumption, but they represented 21% of U.S. grain sorghum exports this week. So just kind of it's always interesting when you see a new country pop up.
Yeah, one of a strong buy from a niche buyer, basically.
Yes, that is correct.
Just keeping it on exports for just a little bit, you mentioned stronger exports for corn, soybeans, and wheat, as most would expect. Anything notable there?
Yeah, so it was kind of a little bit of a mixed week. I'm going to say that corn had some disappointing news in the fact that China, in the weekly announcements, China canceled 15 million bushels of U.S. corn purchases. That was probably the discouraging note on the week for corn, in a week where a lot of things were positive for the U.S. corn sector. That was the discouraging one, and it comes as a big one because we largely depended on China last year for a good chunk of the price rally. It was production related, but it was also demand related due to China increasing purchases of corn. I've been hesitant to go as far as saying that I thought China would come in and buy as much corn this year, largely because we just haven't seen the same signals. And certainly we got some confirmation of that last week when the Chinese attaché report threw some pressure on that corn price by lowering expectations of total Chinese corn imports to 20 million metric tons. That's down from 26 million metric tons. USDA, again, will get a chance to revise their estimates tomorrow as well in their monthly reports. But I think the thing there, at least from a corn standpoint, is China was a big buyer. They're still going to buy some corn because they do need some corn, but it's going to be a less from the global perspective, and it's probably going to be less from the United States as some of their other sources of grain come back onto the scene.
Looking at some domestic factors, specifically within ethanol, what are you seeing in the market there? We're seeing some stocks increasing. So what are the market implications?
Yeah, so we reversed a 2-week trend of decreasing ethanol production. Ethanol production last week was 6,000 barrels per day, up from the previous week. And that's a strong number. I'm not going to sit here and say that ethanol is pulled back to where it's at disappointing levels. We sit at a very healthy margin for ethanol. Year over year, corn used for ethanol sits 9.6% above where we were the same period last year. USDA is calling for about a 6% increase year over year. So corn used for ethanol has been very strong. Even though we did see that stocks number increase, prices for ethanol did turn the corner and go back above $2 last week. Some of that's being driven by the renewed optimism around the competitiveness of ethanol in oil, or at least compared to oil, with the West Texas Intermediate oil contracts trading above $90 and closing above $90 last Friday. That certainly speaks well to allowing ethanol to compete in that picture.
Before we run out of time here, I want to make sure we touch on the ag income expectations and recent updates there for this year. Some factors looking at crop insurance and the ARC and PLC programs. Can you talk a little bit about that?
Yeah, I'll go pretty quick because this really doesn't relate to markets, but I think it's important for producers to just kind of keep in mind. We did get updated farm income forecast for 2020 as a sector. So this is a kind of an indication of how the sector as a whole is doing, not rather individual farmers. So you can sometimes see these numbers go up where individual farmers are feeling additional pressure. But the expectation for farm income in 2022 is down 4.5% from 2021. I remind folks we were at very high levels for 2021, and at $113.7 billion, that remains 15% above our 20-year average when adjusted for inflation for farm income. That's there's a little bit of underlying factors there. Government payments are expected to fall 57% or $15.5 billion compared to 2021. Again, those ad hoc programs just kind of going away. The coronavirus, CFAP payments, the MFP payments that we'd seen in the past. And then the second part of that was weighing on farm income is production costs are expected to increase. I don't think that's a surprise to anyone. Production cost increases up 5.1% for the year compared to 2021. Fertilizer leading the way at up 12%. Feed expenses for livestock producers, largely due to higher grain costs. And then labor up 6% was right in line with U.S. wage increases as well. So my story here, Will, and for our listeners, is that we've got some decreasing income, but still at positive levels or higher levels than what we've seen. We've got a chance to protect some of that risk, and especially now that we know that the majority of that farm income is going to come from cash receipts instead of government payments. There's risk management programs out there, crop insurance. We've got base prices for crop insurance that are well above where we were last year. The soybean price is $2 higher than where we were last year as we head through February. And then, of course, the commodity programs, ARC and PLC, and a reminder to producers that you have to get into your Farm Service Agency office and enroll for those programs by March 15th.
All right. And then a little bit of a forward-looking today, the USDA supply and demand estimates, those come out tomorrow. What are some trade expectations there real quick?
So the February report isn't necessarily known for being a big market moving report. However, I think this February report holds more weight than they've traditionally held. A couple of reasons for that. Everybody's curious about those Brazilian product, South American, not just Brazil, Argentina, Paraguay, Uruguay, estimates for production on corn and soybeans. So that's going to be a primary focus. The trade heading into tomorrow for those regions is basically down somewhere in the neighborhood of 2 million metric tons for most crops, for most countries and most crops, except for Brazilian soybean. And the expectation by the trade is that USDA will lower Brazilian soybean production down to 133.5 million metric tons down. That's down 5.5 from the 139 that they had reported in their January report. So that's a pretty significant revision. I don't know if we'll see USDA go that far in 1 month, but certainly, the expectation is that those will come down. The trade is also expecting that this translates into lower exports by those countries, which then allows the U.S. to pick up some additional demand. And so the expectation is that the U.S. ending stocks of corn, soybeans, and wheat will fall, especially for corn and soybeans, will fall on higher demand, especially in that export market.
All right, well, definitely report to watch. Again, that comes out on Wednesday. Also, the ethanol report is out on Wednesday, and export sales report is out Thursday. So keep an eye on those. Thank you for joining us today. Again, I'm Brownfield's Will Robinson, and I'm joined with Ben Brown from the University of Missouri. Thank you, Ben.